If you're learning to trade, there's a good chance that you've come across two major markets, the Forex market and the futures market. Both are extremely popular with traders, both offer leverage, both can be traded actively, but despite looking very similar on the surface, they can actually operate in very different ways. And depending on the type of trader that you are, one of these markets might suit you far better than the other. So in this video, I want to break down the real differences between Forex trading versus futures trading, and I want this video to be the most complete and comprehensive education on the differences between these two so that you can understand it fully by the end. So make sure that you save this video. You're going to want to watch it a couple of times. We're going to look at how each market works, the advantages and disadvantages of both, and why different traders often prefer one over the other, because understanding the structure of the market you're trading is just as important as understanding trading itself. So let's get stuck in. So let's start with Forex. Forex stands for foreign exchange, and it is the global marketplace where currencies are exchanged. And every time an international trade happens, every time money moves between countries, currencies are exchanged, and that constant exchange creates the world's largest financial market in the world. There's more than $7 trillion traded every single day in the Forex market. Now, retail traders participate in this market by speculating on those exchange rates between different currencies. For example, the euro dollar or the pound dollar or the dollar yen. When you buy a currency pair, you're betting that the first currency will strengthen relative to the second pair, which will weaken against the first. Now, Forex trading is primarily done over the counter, which means there's no central exchange. I'm going to talk more about that in a moment. But instead, trades are executed through a network of banks and institutions and brokers all around the world. Now, let's compare that to futures. A futures contract is a standardized agreement to buy or sell an asset at a predetermined price at a specific date in the future. Futures markets were originally developed for commodities. Farmers would agree to sell crops at a fixed price in advance to protect themselves from price fluctuations. And over time, futures markets expanded into many different assets. Today, you can trade futures on stock indices, currencies, oil, gold, interest rates, and many other financial instruments. But unlike Forex, futures are traded on a centralized exchange, such as the Chicago Mercantile Exchange or the New York Mercantile Exchange. And this means that every trade goes through the same exchange and price feed. And this centralized structure creates a different trading environment compared to Forex. I'm going to explain that very simply in just a moment. One of the biggest structural differences between Forex and futures is this. Futures is a centralized exchange. It's a centralized market. Forex is a decentralized market. Now, let me explain that simply. A centralized market means that everybody's orders go to one central exchange, one central place. So if I want to buy a futures contract, I click buy. My broker then sends that order to that exchange and matches me with someone who wants to sell at that price. And it all happens in one place, one order book, one official record of volume and price. A decentralized market is different. In Forex, there's no single exchange where the whole world sends orders. Instead, trades happen through a network of banks, brokers, and liquidity providers. I'll talk more about that in a moment. So if I click buy on euro dollar, my broker then routes that order through its own network. It may fill that order with a bank or another liquidity provider or another client or internally, and that means that there's no single universal order book for Forex in the same way as there is for futures. And this matters because in futures, everyone's looking at the same exchange data. In Forex, what you see depends partly on your broker and the pricing sources behind that broker. So when people say futures is more transparent, that's what they mean. It's not necessarily easier and it's not necessarily better. It's just more centralized and more visible. So here's a really simple explanation on this. Imagine there are two ways to buy and sell toys. Okay, we have the centralized market and there's one big shop in the middle of town. Okay, and everyone who wants to buy or sell a toy has to go to that shop. So if Billy wants to sell a dinosaur and Sarah wants to buy a dinosaur, then they both go to the same place, and that shop can see everyone who wants to buy and everyone who wants to sell and what price each toy got sold for. Everything happens in one place. That's basically how a futures exchange works. Now, a decentralized market, now imagine there's no single toy shop. Instead, there's lots of different people all over town buying and selling from their houses. So Billy buys from his house, Sarah sells from her house, and Tom has another toy store, toy stand somewhere else, and Lucy's got one down the road. Now there's no one place where every toy is being bought or sold. Instead, it's lots of tiny little deals happening all over the place, lots of different places. That's basically how Forex works. So the key difference here in one sentence is in futures, everyone goes to one exchange, and in Forex, trades happen through a network of banks, brokers, liquidity providers, and it's not one single exchange. So now you might be asking, well, how are orders actually routed? So I want to explain that very simply. Let's say you wanted to buy one futures contract. What actually happens? Well, you click buy on your trading platform, and then your order gets sent to your broker, and then your broker basically just is the doorway into the market. Your broker sends that order to the central exchange, for example, the Chicago Mercantile Exchange, and the exchange looks at a big list of orders. And this list contains people who want to buy, people who want to sell, and how many contracts and what prices they want. And this is called the order book. Now, if someone is willing to sell at your price, the exchange matches you two together, so you become the buyer and someone else becomes the seller. That trade happens, and then the exchange records it. And now everybody on that exchange can see that that trade happened. That's why futures are called centralized, because the exchange is the middleman for everyone. Imagine you walk into one big giant auction room and you shout out, "I'll buy one," and someone else shouts, "I'll sell one." The exchange hears you both, and then done. Trade matched. Everything happens in that same room. Forex is a bit different. Now let's do the same thing in Forex. Let's just say that you wanted to buy the Euro USD. So you click buy on your trading platform, your order goes to your broker. Now this is where it's different. Instead of sending your order to one central exchange, your broker might do one of several things. They might match your order internally against another client. They might send it to a bank, or they might send it to a liquidity provider, or they might take the other side of your trade themselves. Now, I've spoken about that in another video, which I'm going to put here that you can go and watch. That's something you're going to need to watch separate to this video. But one thing I do want to talk about is liquidity providers, because a lot of people don't understand what that means. So what are they? Well, imagine a playground where kids are trading football stickers, and Billy has a Messi sticker and Sarah wants a Messi sticker, but sometimes Sarah wants to buy one, but no one's selling. That's a problem. So the teacher in the playground steps in and says, "Don't worry, I'll always buy stickers and I'll always sell stickers so nobody gets stuck." So now kids can always trade. The teacher is acting as a liquidity provider. They make sure that there's always someone to buy and someone to sell so that the game keeps moving. So in trading, a liquidity provider is a company that constantly offers to buy assets and sell assets, so that all traders can enter and exit trades easily. In Forex, liquidity providers are usually large banks or big financial institutions or hedge funds or prime brokers. People like JP Morgan and Citibank and UPS and Barclays and all those big boys. And these institutions are constantly quoting prices like, "I will buy the euro dollar at 1.0850, or I'll sell the euro dollar at 1.0851. And that tiny difference between those prices is called the spread. And because they're always willing to trade, they provide liquidity to the market. Now, if you imagine if they didn't exist and you want to buy the euro dollar but no one wants to sell, your trade can't happen. The market would freeze. So liquidity providers prevent that from happening by always standing ready to trade. They make sure the market keeps moving. So here's what happens step by step when you click buy in Forex and it goes for a liquidity provider. You click buy on euro dollar on your trading platform. Your order then goes to your broker. Your broker then sends that order to its liquidity network. And this might include several liquidity providers. For example, bank A, bank B, hedge fund, institution, and then the broker chooses the best available price. For example, bank A might be 1.0851, bank B might be 1.0852, hedge fund might be 1.0850, and your broker will route the trade to that hedge fund because it offers the best price. So then your trade gets filled, the bank's now on the other side of your trade, or the hedge fund, and that's it. Think of liquidity providers like supermarkets. Supermarkets always have food available to buy. They don't wait for another customer to show up with food to sell. They stock the shelves themselves. Liquidity providers do the same thing in financial markets. They constantly provide prices so that traders can buy and sell. And they create three important things. One, tight spreads. So more liquidity providers competing means better prices. Number two is faster execution, so orders get filled quickly. And number three is market stability. There's always someone willing to trade. So to summarize, a liquidity provider is simply a large financial institution who is constantly willing to buy or sell currencies so that traders can enter and exit markets easily. But ultimately, your trade gets filled somewhere within that broker's network, but it doesn't go to a central exchange that everyone else in the world's using. So that also means that another broker might show slightly different prices because they might be connected to slightly different banks or liquidity sources. And that's why Forex is called decentralized, because there's no single place where every order meets. And all of this matters because the market structure affects what you can actually see. In futures, because everything goes through one exchange, traders see the centralized volume, the order book, the market depth, the time and sales. That means that if 500 contracts trade, that trade is recorded at the exchange. There's a clean record of what happened. In Forex, there's no single master record for the entire market. So what you see depends on your broker, your liquidity providers, and their price feeds. You can still trade Forex particularly well, but you're not seeing one universal order book for the entire global market. And that's a big difference. Forex is the largest financial market in the world. The daily volume exceeds $7 trillion, as I said. And because of that enormous liquidity, major currency pairs tend to move smoothly and spreads are often very tight. Futures markets are smaller in comparison, but they're still extremely liquid. Major future contracts like the S&P 500 or Treasury futures trade billions of dollars every day. For most retail traders, liquidity isn't usually a problem in either of these markets, but Forex tends to dominate when it comes to overall size. Now, both Forex and futures allow traders to use leverage, but they approach it slightly differently. In Forex, brokers often offer extremely high leverage. Some brokers offer leverage ratios of 50 to 1 or even 100 to 1, even higher actually. And that allows traders to control large positions with relatively small deposits. However, high leverage also increases risk dramatically. It's a double-edged sword. In the futures market, leverage is built into the contract through something called margin requirement. Instead of choosing a leverage ratio, traders have to deposit a certain amount of capital to trade a contract. For example, trading an S&P 500 futures contract might require several thousands of dollars of margin. And this tends to create a slightly higher capital requirement compared to Forex, which is very low. Speaking of costs, trading costs differ between the two markets. Forex traders typically pay the spread, which is the difference between the buy price and the sell price. Some brokers also charge commissions. In the futures market, traders usually pay a commission per contract plus exchange fees. Spreads are often extremely tight because pricing is centralized through the exchange. The overall cost difference depends on the broker, the contract size, and the trading style. Active day traders often analyze these costs carefully when choosing a market. Now, the Forex market operates 24 hours a day, 5 days a week, because currencies are traded globally and the market follows major financial centers around the world: London, New York, Tokyo, Sydney. This makes Forex very attractive for traders that want flexible trading hours. Futures markets also trade nearly around the clock, but most futures contracts have specific trading sessions and peak liquidity periods. Many futures traders that I know focus on particular sessions, such as the US market open. So, which market is better? The honest answer is neither. They simply suit different types of traders. Forex is often popular because it has low barriers to entry, it offers flexible trading hours, it allows small accounts to participate, and the futures are often popular because the market is a centralized exchange, price, data, and volume are transparent, order flow tools are available, and some traders prefer Forex because of accessibility, others prefer futures because of transparency and exchange regulation. Ultimately, the best market is the one that fits your strategy and fits your personality and fits your risk tolerance. Forex and futures are both very powerful trading markets. They both offer opportunities for traders who approach them with discipline and structure. They just operate slightly differently. Forex is a decentralized global currency market. Futures are standardized contracts traded through centralized exchanges. But understanding these differences allows traders to make informed decisions about where they want to focus their efforts. Because successful trading, as we know, isn't just about strategies, it's about understanding the environment you're operating in and choosing a market that suits your style. So me personally, I prefer Forex trading because that's what I've been brought up on. That's what I'm at home with, I'm comfortable with. But I know many other traders that trade futures as well. It doesn't mean one's better than the other. It just pick what suits you. If you want me to dive deeper on futures and Forex in any way, let me know in the comments. If there's any questions you've got about this particular video, let me know in the comments. And if you want to learn more about Forex trading, I have a 30-day trader challenge, which could help get your feet wet if you're not too sure if this is for you or not. Or if you really want to go all in, you can check out tier1trading.com. And until next time, take care, and I'll see you in the next one.